I want you to stop whatever you are doing right now and pay attention to me for the next 20 minutes, because what is happening in the gold market right now is the clearest signal I have seen in my entire career that something massive is shifting in the global financial system, and the people who are ignoring it are going to spend the next decade figure out where wealth went. I am not a gold bug. I have never been a gold bug. I built my fortune in tech, in basketball, in startups, in businesses that create real cash flow and real value. Gold has never been my first call. So when I tell you that smart money, serious institutional money, sovereign money, the people who manage the largest pools of capital on the planet are panic buying gold right now at prices nobody thought were possible 2 years ago, I need you to understand that this is not a sentiment shift. This is a structural alarm going off in the global financial system, and the alarm is getting louder every single month. Let me give you the numbers first, because the numbers are what matter, and the numbers right now are extraordinary. Gold hit $4,000 an ounce for the first time in history in October of 2025. Before that, it set 53 separate all-time highs in a single calendar year. 53. The price of gold has gone up more than 55% in 2025 alone, making it the single best performing major asset class on the entire planet, beating stocks, beating bonds, beating real estate, beating crypto in terms of risk-adjusted performance. And right now, as I am making this video, gold is trading above $4,700 an ounce. JPMorgan, one of the most sophisticated financial institutions in the world, has called gold their highest conviction long bet for 2026 and is projecting prices pushing toward $5,000 by year-end. Goldman Sachs sees a path to $6,000 an ounce longer term. These are not fringe predictions from people trying to sell you gold coins on a cable TV commercial. These are the biggest, most resourced, most data-driven financial institutions in the world making public calls that would have sounded insane 3 years ago. So the question you need to be asking yourself is not whether gold is expensive right now. It obviously is more expensive than it has ever been. The question is why. Why is smart money moving this aggressively into an asset that pays no dividend, generates no cash flow, and just sits there? The answer to that question is going to tell you more about the real state of the global financial system than anything you will read in a mainstream newspaper this year. Here is the first thing you need to understand, and it is the piece that most financial commentary completely glosses over. Central banks around the world bought 863 tons of gold in 2025. And before you say, okay, so what? I need you to understand what that number means in historical context. From 2022 through 2025, central banks averaged roughly 1,000 tons of annual purchases compared to approximately 200 tons per year in the prior decade. 5 times more. Central banks collectively decided to buy 5 times more gold per year than they used to, and they are doing it while prices are at all-time highs, which means they are not bargain hunting. They are not buying the dip. They are buying gold at the most expensive prices in history, because to them the price tag is not the most important variable in the decision. The strategic imperative is, and that strategic imperative has a name. It is called De-Dollarization, and it is one of the most significant structural shifts in global finance since the end of the Bretton Woods system in 1971. Let me explain what de-dollarization actually means, because it gets thrown around a lot in a way that overstates some things and understates others. De-dollarization does not describe the imminent collapse of the US dollar as the world's reserve currency. It describes a more measured process of the gradual reduction of exclusive dependence on dollar-denominated assets by sovereign institutions seeking to hedge against sanctions exposure, currency weaponization, and long-term fiat debasement. That is a very important distinction. The dollar is not going away tomorrow. The dollar is still the backbone of global trade and global finance. But the countries that manage the world's largest sovereign reserves are quietly and systematically building a layer of protection underneath their dollar holdings that cannot be frozen, cannot be sanctioned, cannot be printed into debasement, and cannot be weaponized by any single government. And that layer is gold. China continues to hold more than $3 trillion in US dollar-denominated assets despite years of reducing its treasury holdings. But what is changing is the composition of the layer sitting alongside those dollar holdings, and gold is the primary beneficiary of that reallocation. I want to talk about the specific moment that changed everything for sovereign reserve managers around the world, because I think most people have forgotten about it or never fully processed its implications. In February of 2022, when Russia invaded Ukraine, the United States and its allies froze approximately $300 billion of Russian sovereign foreign exchange reserves. $300 billion of assets that a sovereign nation had accumulated over decades sitting in dollar-denominated accounts, and they were gone in a weekend. Frozen, inaccessible. Now, I am not here to defend Russia or their actions. I am here to tell you that every single finance minister and central bank governor in every country that is not a close ally of the United States watched that happen and thought the same thing. That could happen to us. That single event was a structural wake-up call for sovereign reserve managers worldwide, and the data shows it clearly in central bank gold purchasing behavior from 2022 onward. Physical gold sitting in your own vaults cannot be sanctioned. It cannot be frozen by a foreign government. It cannot be made worthless by someone else's monetary policy decisions. In a world where financial infrastructure can be weaponized, gold is the asset that sits completely outside that vulnerability. And once you understand that logic, you stop being confused about why central banks are buying gold at $4,000 an ounce, and you start being surprised that they are not buying more. Now, let me talk about the debt piece, because this is where it gets really uncomfortable and where I think the gold story connects to something much bigger than just a trade or an investment thesis. U.S. national debt is approaching 140% of GDP in 2026, and the interest payments on that debt are approaching $1 trillion annually. $1 trillion a year just in interest, not building anything, not defending anything, not investing in infrastructure or education or innovation, just the cost of money that was already spent. And here is the part that should genuinely disturb you. That interest bill grows automatically every single year without a vote, without a debate, without any politician having to stand up and say, yes, I am choosing to spend this money. It just compounds. And the only realistic way a government manages a debt load this large without defaulting is to make the currency worth less over time. Since 2020, American consumers have lost nearly 20% of their purchasing power in US dollars, according to Bureau of Labor Statistics data. 20% in 5 years. That is not a rounding error. That is a fundamental erosion of the value of the dollar that affects every single dollar sitting in your savings account, your money market fund, your checking account, and any fixed income investment you own. And gold, which has existed as a store of value for 5,000 years, does not get printed. It does not get debased by a committee decision from 1971 when the U.S. abandoned dollar gold convertibility through 2025. Gold rose from $35 per ounce to over $5,000 per ounce. That is not a coincidence. That is the market pricing in 50 years of dollar debasement in real time. Here is something I want to challenge directly because I hear it constantly and it drives me crazy. People say gold is just a fear trade. People buy it when they are scared and sell it when things stabilize. And historically, there was some truth to that. But what is happening right now is fundamentally different, and the data makes it clear. Gold's 2025 performance is not a speculative anomaly. It is a reflection of shifting global fundamentals. In an era defined by currency realignment, fiscal excess, and geopolitical volatility, gold has reasserted its historic role as the ultimate store of value. The buyers this cycle are not panicking retail investors buying coins on late-night television. They are sovereign wealth funds. They are central banks. They are institutional portfolio managers at the largest asset management firms in the world. Wealth managers are now allocating an average of 2.8% of assets under management to gold, up from less than 1% a decade ago. And here is the critical data point that tells you this run is not over. Despite gold being 80% higher since early 2025, global gold ETF holdings remain below the November 2020 peak of approximately 3,929 tons. The Western institutional money, the pension funds, the endowments, the large asset managers have not fully re-entered this market yet. The next major leg of gold buying demand has not even shown up yet. Let that sink in for a second. Prices have gone from around $2,000 to over $4,700, and the biggest pool of institutional capital in the world is still largely sitting on the sideline. When they move, it will not be subtle. I also want to address something that people in the gold skeptic community always bring up, and that is the interest rate argument. The conventional wisdom has always been that rising interest rates are bad for gold because gold pays no yield. So when you can get 5% from a treasury bond, why would you hold something that pays you nothing? And for most of the past 50 years, that conventional wisdom held up pretty well. But it completely broke down starting in 2022, and it is still broken today. Current trends deviate from this norm due to sustained inflationary pressures and de-dollarization, which has helped sustain strong investment demand for gold even in high-rate environments. What this tells you is that something fundamental has changed in how sophisticated investors are thinking about gold. It is no longer just an interest rate trade. It is a currency confidence trade. It is a geopolitical hedge. It is a fiscal sustainability trade. And those drivers do not go away when the Fed raises rates because those drivers are about something deeper than the short-term cost of money. They are about whether the entire framework of dollar-dominated global finance is as stable as it looked 10 years ago. And increasingly, the answer that smart money is arriving at is no, it is not, and we need to hold something outside that framework as insurance. Let me talk about China specifically because I think the China story within the gold market is one of the most underreported and most important dynamics happening right now. Gold investment demand in China has surged in recent years, driven by weakness in equity and property markets. The Chinese stock market has been a frustrating place to be for retail investors. The property market, which was the primary wealth storage vehicle for hundreds of millions of Chinese middle-class families, has been in deep distress. And so Chinese savers, who are culturally inclined toward tangible stores of value, have been pouring money into gold at a scale that is genuinely staggering. In early 2025, a pilot program allowed 10 Chinese insurers to allocate up to 1% of their assets to gold, and if the People's Bank of China raises these limits, institutional demand could grow substantially. Think about what 1% of Chinese insurance industry assets means in dollar terms, and then imagine what happens when that limit gets raised to 2% or 5%. China has also announced plans to serve as custodian for foreign sovereign gold reserves, which is a geopolitically significant move that reflects Beijing's ambition to position itself as an alternative to Western financial infrastructure. China's People's Bank of China reached an all-time high of approximately 2,309 tons of official gold reserves in the first quarter of 2026. And that number is going to keep climbing. Now, I want to get practical because theory without action is entertainment, not education. Let me tell you specifically how I think about gold in a portfolio and what I think the realistic options are for someone watching this video who wants to get positioned. First, let me be clear about what gold is and is not in a portfolio. Gold is not a growth asset. It is not going to compound your wealth the way a great business does over 20 years. I built my wealth through businesses and cash-flowing assets, and I am not going to pretend gold is a substitute for that. What gold is in the current environment is insurance. It is the part of your portfolio that does not correlate with the system risks that are building up across the global financial structure. Historically, gold has generated positive returns during every major risk event of the past 25 years, from the global financial crisis to the 2025 tariff wars, and over the past 25 years, gold has delivered cumulative returns exceeding 1,300%, outpacing global bonds and rivaling major equity indices. That is an extraordinary track record for something that just sits there. And the reason for that track record is that every major risk event of the past 25 years has involved some version of monetary policy stress, debt concerns, or currency confidence issues, which are exactly the conditions under which gold performs most consistently. The question of how much gold is right for any individual portfolio depends on your specific situation, your time horizon, your other assets, and your risk tolerance. I am not your financial advisor, and I am not going to pretend I know your situation. But I will tell you what the institutions that I respect are doing. Investors have been advised to allocate between 5 and 10% to gold via bullion or ETFs as geopolitical risks persist. That is a reasonable starting framework for most people. 5 to 10% of your investable assets in gold-related positions provides meaningful protection without concentrating so much in a non-yielding asset that you sacrifice your growth potential. The specific vehicle matters too. Physical gold, gold ETFs, and gold mining stocks all have different risk profiles and different exposures to the underlying gold thesis. Physical gold is the purest expression of the thesis. It is literally the thing that cannot be debased or sanctioned, but it has storage and security considerations. Gold ETFs like GLD or IAU give you clean liquid exposure to the gold price without the storage headache. Gold miners are a leveraged play on gold prices because the margins of mining companies expand dramatically when gold prices rise, with all-in sustaining costs averaging around $1,600 per ounce. Nearly every producer remains profitable at current prices near $4,000 per ounce, resulting in record margins across the industry. But miners also carry operational risk, management risk, and geopolitical risk depending on where their mines are located. My personal view is that for most people, the ETF route is the cleanest and most efficient way to get the exposure you want. I also want to address the elephant in the room, which is whether you have already missed this move. Gold is up over 55% in 2025 and another meaningful amount in 2026. It feels expensive. It feels like the time to buy was 2 years ago. I get it. That is a completely natural and human way to feel about any asset that has already moved significantly. But here is what I know from 40 years of watching markets. The question of whether you have missed a move is the wrong question. The right question is whether the underlying thesis is still intact. And in the case of gold, right now, the underlying thesis is not only intact, it is getting stronger. The debt levels are still growing. Global sectoral debt rose to $340 trillion in mid-2025, and the government's share of that debt also reached a record 30%. The de-dollarization trend is still accelerating. The geopolitical fragmentation that makes sovereign reserve managers want an asset outside Western financial infrastructure is not resolving, it is deepening. The Western institutional money that represents the next major demand wave has not yet fully entered the market. The specific macro conditions that drive gold demand, which include negative real yields, dollar weakness, fiscal stress, and geopolitical uncertainty, are all still present and in some cases intensifying. The thesis is intact. The window is still open. The question is whether you are going to act on it or spend the next 2 years watching from the sideline. There is one more thing I want to talk about, and it is something that almost nobody discusses when they cover the gold market, and I think it is actually the most profound long-term argument for gold that exists. VanEck's emerging markets bond team calculated that the price of gold equalizing central bank money liabilities would be approximately $39,000 per ounce under a dollar reserve loss scenario, and under a broader monetary framework, the implied price reaches approximately $184,000 per ounce. Now, I am not sitting here predicting gold goes to $39,000. That is an extreme scenario, and I do not think it is the base case. But the fact that serious institutional analysts are doing this math and publishing it publicly tells you something important about how the people who manage the world's largest pools of capital are thinking about tail risk right now. They are thinking about scenarios that 10 years ago would have been dismissed as paranoid. And the reason they are thinking about those scenarios is not because they are pessimists or conspiracy theorists. It is because the data on fiscal trajectories, on de-dollarization trends, on the weaponization of financial infrastructure, on the structural erosion of confidence in traditional safe haven assets, actually supports taking those scenarios seriously as low probability but non-trivial possibilities that a rational portfolio manager needs to hedge against. Here is where I land on all of this, and I want to be as direct as possible because I think you deserve a clear conclusion rather than a bunch of maybes and what-ifs. The smart money is not panic buying gold because they are scared. They are buying gold because they have done the analysis and they have concluded that the risk-reward of holding gold at current prices is still strongly favorable given the combination of structural demand drivers that are still intact and accelerating. The central banks are not going to stop buying. The de-dollarization trend is not reversing. The fiscal math of the United States and most major Western economies does not improve without either a growth miracle or some form of monetary management that erodes the real value of the debt. And gold is the one asset that has consistently maintained its purchasing power across all of those scenarios for 5,000 years. I am not telling you to put your entire net worth in gold. I am not telling you to buy gold instead of building businesses or investing in equities or building skills that generate income. What I am telling you is that the people who are managing the most sophisticated pools of long-duration capital in the world have collectively decided that gold deserves a meaningful allocation in a way that they have not believed since the early 2000s. And when that many smart people with that much data and that many resources arrive at the same conclusion, the right move is not to sit on the sideline arguing about whether gold is too expensive. The right move is to understand why they got there, decide whether the thesis makes sense to you, and then act accordingly. The window is open. The thesis is intact. The choice is yours.